Hey there, everybody. Welcome to the video podcast. I'm joined as always by my colleague, Jake Sadler in North Carolina. And we're going to talk about some fun stuff about potentially remodeling your home, renting your home, and these things, how they've been affected by the current rise in interest rates over the last, we'll say, 12 months. So that's the topic today. And last week I called it a show, and I'm sure Jake's going to comment on the change of description here from podcast to show. So I'll get that out of the way. How you doing, Jake?
I'm doing well. I'm doing well. This is really a test for all of our listeners out there to see who wants to comment on and suggest new names for our show. Video podcast could be a good one. So
We need a comment. We need some comments in there, like positive comments, of course. But
positive comments only.
It'd be nice to know how helpful this is. I just have a lot of fun having conversations with you, so I'm going to continue doing it regardless. Commenting too would give me some a positive lift.
This is this is just a good conversation. So I think the conversation we're going to have today is pretty good too. And just talking about mortgage rates and changes over the past kind of 18 months and what that means for the decisions that a lot of our clients and just homeowners in general are facing. You know, if you get locked in, so to speak, into a nice low interest rate, maybe you locked in, 2019, 20, 21, and then, all of a sudden rates have gone up. And for some folks that can feel kind of constricting.
Hey, instead of waiting to the end of the show, you got any fun facts for me?
I do have a fun fact for us. So, just looking back at average interest rates, 30-year fixed mortgage rates, so conventional mortgage rates in the U.S. And in 2022 to 2023, the average 30-year rate spiked, right? And we all kind of felt this out in the news. It went up to about 5.5%. And that was up from kind of its low point, just under 3% in 2021. That was the average for the year. And that move from like 3% to 5.5%, that's a big move. That's a big change in kind of the wrong direction, so to speak, if you're out shopping for a house, that sort of thing. But interestingly, looking back at the average rate since 1971, just to kind of put where we are at this new, now higher rate, about 5.5%, what do you think the average rate since 1971 for a 30-year fixed mortgage is, if we take all those years together?
So you said we're at about 5.5 now, and we were about just under 3.
Just under 3. Yeah.
I know in the 80s it was around 13. So I'm going to take a shot and say about 6%.
Okay, 6%. That's you're in the right direction. So average since 1971 is higher than the current average at about 5.5%. The average since 1971 is 7.75%.
Yeah, we've been spoiled.
So, we have been spoiled, and for so long we've been using the term historically low interest rates, and we were using that term for so long that I think we all just became complacent in these are the historic lows. Well, now it's just a new normal.
Yeah.
But no, this was a moment in time that lasted for quite a few years where rates were at historic lows.
Yeah.
And we've moved out of that.
And now that they've changed, I think you were talking, you mentioned you had a case like this, and I know I've had cases like this. Now that they've changed significantly, I think people are thinking differently about their home. So instead of moving, I think you were talking about a scenario the other day, or that you've seen a lot, is people are improving their homes significantly because they're locked into these low rates, and so they're saying, all right, what do I want to do? I can't move because I don't want to give up this rate. It's going to cost me too much. So they're improving their homes. Is that fair? You're seeing that quite a bit?
Yeah, I think what's happened, at least in things that I've observed in conversations that I've had, is the landscape for the decisions that homeowners that had locked in, say, a 30-year fixed rate mortgage at 3% or below, I think the set of decisions that they have in front of them is different now than they had in the past. So in the example of, okay, you had a low interest rate mortgage, or if you had a higher interest rate mortgage and you were shopping and you wanted to move, just say as the example. A lot of times folks want to move, whether it's, any number of reasons why they would want to move, but a lot of times you want to move up. You kind of want to increase in, fit and finish and overall cost for the house. That's a little bit easier to do if rates are lower now than when you bought your house originally, or if they're the same. You can kind of make a lateral move, take the equity that you have in your current primary residence, use it kind of as a down payment, most typically on the new house, and then finance the remainder. And that works out pretty well for a lot of folks as a strategy. And so because that's appealing, you kind of move up in the housing market, that becomes the elephant in the living room, so to speak, the decision. It's like any other decision has to be better than that one. And so, but now it's different. Interest rates have gone up. And so for folks that kind of have those golden handcuffs, so to speak, that got that nice low interest rate, now they're saying, okay, if I want to move up in the housing market, I can take all the equity that I have in my current primary residence, put it into the new property, finance the remainder, and those numbers just don't work for my situation. I can't actually afford that mortgage.
Yeah.
Because the rates have gone up. And overall, we've seen substantial appreciation in most markets in the country, over the past 5 years.
Yeah. And so
with
clients or people looking to upgrade or move up, they're not only potentially have an increase in the price that they're paying just because they're going to go maybe from a smaller house to a larger house. So they're naturally moving up there. But now they're going to have also that is going to be a larger payment because the interest that they're paying on that higher balance is higher. So it's a double whammy.
Yeah, exactly. So I think now that kind of the decision that was maybe for a lot of folks kind of what they felt was the obvious for them to move up in the housing market, that was kind of not really adding up. So what are my other choices? It's we've kind of entered this realm of exploring alternate options and these other decisions. And the most common ones we hear, okay, well, we're happy where we are. We don't really need to upgrade, but we want some changes in our house. Yeah. So let's go ahead and tap into some of the equity we have in our house and do some improvements. Maybe put an addition on, maybe do some renovation, some remodeling, that sort of thing, and improve the overall fit and finish of the current property. So you keep your nice low interest rate mortgage, and you tap into the equity that you have in your house, either through a home equity line of credit or home equity loan. We've talked about those in the past as ways to finance these types of improvements.
Yeah, so you're talking about upgrading your home by remodeling, so you're putting more money into it, and you're able to keep that lower interest rate, let's say it was 2.75% or something like that on the main portion of the home. But now you maybe got to borrow a little bit at a little bit higher rate on a home equity line of credit or loan, which we've talked about in the past. So that is a smaller portion if you are borrowing for it at a little bit higher rate, and it makes it a little bit easier to swallow.
Yeah, exactly. In a lot of ways, I think the numbers kind of tend to work out. It's as if you are, kind of moving up in the housing market in the older interest rate environments. So you're improving your property. Maybe you're adding square footage. You're increasing the quality of the house, that sort of thing, and we're most likely increasing the market value of the property at the same time. And in order to do that, there's a cost associated to it. And if you finance it, that's going to increase kind of your overall month-to-month outlay, but that increase in, say, your monthly payment as a total is kind of equivalent to what it's not a leap, it's just a small jump to kind of, improve or move up in the housing market. You're just staying in your current primary residence.
So we're not making a recommendation to do it one way or the other as part of this conversation. I think we're just talking about some of the things that the challenges people run into when they're trying to move up in a house when interest rates have changed significantly. They have now.
Yeah, exactly. I mean, and this is the thing which is really interesting about just talking about this. At the end of the day, it still boils down to what's your situation? What's your motivation for wanting to move? What's your motivation for wanting to, make some improvements to your property?
Yeah.
Do you really need to do these things, or is this a need or a want? And kind of, maybe it's a little bit of both, but I think it's still an exercise in exploring your motivations and your rationale and your objectives behind making these big decisions.
Yeah, no doubt. Have you seen the reverse happen where people are getting ready to retire? They want to downsize, and maybe they don't have a ton of equity in their home, and they thought maybe they would have gotten a lower payment if they downsized, and now they can't really downsize. So have you seen people staying in their homes for that reason too?
Yeah, I haven't seen, folks necessarily staying in their home for that reason, but what we are now seeing, probably the conversations we have in those types of situations are, should we pay cash?
Yeah,
If we're going to make a downsizing move, do we pay cash for this new property or do we finance?
yeah,
And so that's another kind of new element or kind of new decision that a lot of folks have in front of them at the moment is, should I, if I am going to make a move, should I put more down? Should I pay all in cash? Should I finance? Should I finance more? And, rates have gone up. So that equation, those numbers have changed a little bit. I think when we were looking at those years where we were at those historically low rates, in a lot of cases, it was really a pretty straightforward answer, from our perspective, at least, to just finance what you need to finance. Don't aggressively pay down this debt unless you really have that as a high priority.
yeah. Because one of the
Yeah, I
things,
think the numbers have changed.
yeah, and one of the things we look at is, all right, so we're going to put this money in a house and um, essentially guarantee a 2.75 investment return. Whereas if we didn't put it in the house and we invested it, we'd have to just outperform 2.75, which is not a super aggressive portfolio. And now we got to outperform like 5.5%. And that becomes a little bit more risk with your money and just can be a little bit harder to swallow, even though rates have gone up. So, but that's the equation.
Yeah.
That's what we're looking at is like how much risk do we need to take in order to outperform the borrowing rate?
Yeah, for sure. And so I think, for folks in that situation, maybe in retirement or entering into retirement and looking at downsizing, and that really becomes, the kind of element of the conversation that we focus on the most.
Yeah. So one of the other things, because of these, well, I'm not going to blame it on the rise in interest rates. I'm going to blame it on the historic lows. People that do decide to move and do decide to upgrade or move their house, you've called them accidental landlords because they're keeping their homes, renting them out, turning them into rental properties because they have this low payment on them, and maybe they purchased them at a lower value when the market was down, the real estate market was down, and so they're profitable investments. You've seen that a lot.
Yeah, for sure. And I don't think I didn't come up with the terminology. There's a good article in the Wall Street Journal that came out earlier in May, and really just talking specifically about this idea where homeowners, they kind of have this nice low interest rate and they want to move up in the housing market. And for some folks, and it just depends on the numbers and it depends on your situation, but for some folks, what has been an appealing and potentially attractive option is to keep your current primary residence, buy a new primary residence, and then rent out your old one.
Yeah.
And the term accidental landlords, it kind of comes from, we've had these conversations with folks where this is the strategy that works for them and it makes sense for them right now. But if you talk, with folks, this isn't something that they had always thought about wanting to do or plan to do. It's just now in these unique circumstances, this is appealing and this is attractive and this can make sense and we can make this work financially for us. And the idea, again, like I think you were describing it earlier, was you have this nice low interest rate on your old primary residence. You move into the new one and it's more expensive, right? And maybe, you've had some increases in household income that can help to support that. But if you rent out your old property, then you could potentially have a nice boost in your household cash flow to kind of cover the difference or at least narrow the gap between the cost for your old primary to your new primary and make it more affordable. So with these rising rates, overall, rental rates have also gone up across the board. So that's kind of another element to this. So you have your old primary with a low interest rate. Rental rates across the board have gone up. So now you can charge more, and your monthly payment from this low interest rate mortgage is already low. So again, I think kind of adds to the numbers, for your cash flow to make it work in the way we just described.
What are three things? Well, I'll rephrase that question. I'm thinking of three things that may affect your decision to be a landlord.
Three things that would
Yeah, three things that you really need to consider when you're making that decision to be a landlord, or when you're going to rent your primary residence, I should say. See if we can match up.
well, I know you're going to say taxes is one.
Taxes is one of them. You got it. You got it.
We'll put taxes up. We'll definitely put taxes on the list. So
Yeah.
wait. So what's the question? Three things you want to consider?
Yeah, like three things that you need to consider when you're deciding to be a landlord, and we'll just we'll dial it in a little bit. So, and landlord on your previous primary residence, because that's when taxes really come into play. Or this,
yeah.
So
For sure, taxes is first and foremost. We'll kind of come back to that one, but I think the other ones that really come to mind, and this is the one we always think of. We have kind of the privilege of hearing a lot of different stories from folks and their experiences as a landlord, and it is not all roses and sunshine. We've heard a lot of horror stories about being a landlord. So there is added risk. You are adding risk to your financial situation. You are adding potential headache and heartbreak and a whole list of other things that you have to deal with. You have the administrative issues that come with it. And on the surface, the idea of, okay, I'm going to rent my property out and have this nice cash flow and I can use it all for my own benefit and, kind of offset the now higher costs for a new primary residence, that whole thing. Well, you still have to manage this property like a business. Yeah. And that's the other thing that comes to mind. I mean, being a landlord is very much a job description. So you really need to be attuned to operating this as a business, honoring kind of what you need to do financially, honoring kind of the accounting that needs to go into this and the record keeping that needs to go into this and the savings that needs to go into this. You need to be prepared for contingencies, emergencies, repairs, all this sort of thing, and vacancies. So it's nice to think that you have a vacancy and you have a dozen applications on your doorstep. Yeah, that's happening out there, but it doesn't always happen. So you really have to be prepared and willing to accept the risk that you're taking on, and you are adding risk to your situation. But I think taxes is entirely central to this. I'll let you kind of take the lead on describing, as a consideration, some of the tax implications.
Well, what you described was one of really the key factors too that I just want to reiterate is, being a landlord is not super easy. And I've heard stories where people come in and be like, oh yeah, landlord's fantastic. I got all these rental properties, no issues at all. And I've heard stories with people with one landlord and they got craziest renters in there. And it's just been, worst case scenario. So there's that. And then you're right on target with the cash flow. It's not, you got to be prepared to not have a renter in that house for a long period of time. So if you're relying on that cash flow, you got to be really careful. And before I get to taxes, one of the other things people got to consider, I guess, is do you need the money in that home as a down payment on a new home? Because as a rental property, it gets tied up and left into that, left in there. So you can't necessarily use it to purchase the new home.
Yeah, and I think, that was one of the points we kind of wanted to make in terms of this kind of emerging kind of idea, being an accidental landlord, is that part of this strategy that's really appealing to a lot of folks is that you tap into the equity that you have in your home by opening up a home equity line of credit, and you use that as a down payment on your new primary residence. So that's part of the strategy that's kind of being talked about right now, because to your point, otherwise, you're either going to need to put next to nothing down, or save separately and use separate savings as a down payment on your next primary.
Yeah. So taxes, when you're renting out your primary residence, I wanted to hit this home pretty good. Is that you have a window of essentially you can get a exclusion on gain of the sale of your home If you're single, up to $250,000. If you're married, filing jointly, up to $500,000. If that home has been your primary residence and you've lived there, you've owned it jointly for the last 2 out of the previous 5 years. So you have this window where you could potentially lose a substantial tax deduction up to $500,000 if you go, past that 3-year time frame. You've no longer have lived in that home for 2 out of the past 5 years. You could potentially have a big tax bill to pay. So you got to be really careful of that. And not only that, is you've been depreciating this home over time, and so that adds to it. If you decide to sell it in a couple of years, you have some depreciation recapture, which can be a hefty tax to pay. So I just wanted to hit home on that.
I want to come back to the capital gains exclusion because that's really important. But can you kind of like describe depreciation a little bit and just sort of like if you are embarking on this kind of new journey, if you're a new landlord, what is depreciation? How does it work? How can it benefit you? That's a lot. I'm taking on a
I was not prepared to talk depreciation right now. So the rules for depreciation are tricky, but in general, you can essentially expense what you paid for your home and use that expense to offset income you receive for a period of time. So for a rental real estate property, you're going to have to do some quick math for me. But if you paid $500,000 for that house, you can depreciate that house, if it's a rental property, over a 27 and a half year time frame. So that means you take $500,000 and you divide it by 27 and a half, and essentially that amount is what you can use to offset $18,000 you can use to offset income that you receive. So that's a pretty good deal, up front. Let's say you have a profit on your house over and above the interest and real estate taxes you're paying if you're renting it, then you can take that depreciation and you can offset some income so you're not paying taxes on it, which is great.
It is great. I mean, like, what a huge expense, like, you can deduct against your income that's coming in. And for a lot of folks, that's going to erase a lot of their rental income for the year. And on top of that, you get to deduct some other expenses, right?
Yeah, you can deduct your real estate taxes. You can deduct, the interest that you're paying on a home, repairs and maintenance, any fees you're paying. There's some rules around, travel to repair the home and so forth. But yeah, there's definitely a lot of expenses, insurance costs that you can, wouldn't be deductible if it was your primary residence that are now deductible if it is a rental property. So yeah, really, really valid points in terms of that. And it gets complicated because, a lot of people will, or rental properties, generate losses. So the rental income may be $20,000 and depreciation is 18, interest and so forth. And you can actually, in a lot of cases, use that loss to offset income. And most people expect that to happen. But once you get over a certain income level, you don't get to deduct those losses and you have to carry them forward. And you can deduct them once you actually sell the property. So
I'm like getting really excited, because we're talking about, this is an interesting aspect, and I think it can be really daunting for folks as well. If they are interested in owning an investment property, owning a rental property, they have some questions around what are the tax implications here? And a lot of what you just described, it's exciting because now you have this whole new opportunity set for your tax planning. And so this is going to enhance in some ways. It's going to complicate, but also potentially enhance your tax situation, at least for some period of time. And it's also, I think, again, pointing to the fact that if you embark on this, if it's your first time as a property owner, enter the job description. Okay. These are business-like deductions, right? So we need to operate this and think of this as a business. So I think that kind of gets pretty exciting to talk about the tax piece.
Yeah, no doubt about it. And there's some potholes you could step into. It's one, if you live in it, if you rent it out too long and you lose an exclusion, I mean, that can be valuable. $30,000-$40,000 you could lose in terms of a tax. But on the flip side of it, that depreciation when you sell a property, you actually have to do what's called recapture, and that reduces the basis in the home that you go to sell. And then so some people are like, hey, I purchased this home for 500, I'm selling it for 500, I'm not going to have any tax. And I'm like, whoa, wait a minute. You actually depreciated over 27 years. The basis is actually zero. You're going to have a lot of tax. So you got to be, like you said, you got to own it. You got to be aware that these things are happening, so you're not caught off guard in the end. And again, like you mentioned, it is exciting because there are tax planning opportunities where you can do an exchange for the property. You can go into another rental property and defer that gain down the road. And so there's some things to look out from a tax perspective, which definitely need to be considered.
But I think, back to the 2-year clock, or, the 5-year clock, whatever, however you want to look at it. So, but the capital gains exclusion. So I think this is something that if for folks that are, again, they're looking at their first rental property and they're kind of going about it in the strategy that we're describing. So using your last primary residence, that's going to be the rental property. You have a capital gains exclusion, but the day you move out, that clock starts ticking. So the last thing that you will want to have happen is to sell that house 3 or 4 years in. So you've lost your capital gains exclusion. You tried your hand at being the landlord. You didn't really like it. It just wasn't all you thought it was cracked up to be, but you waited too long to get the capital gains exclusion. So if you're trying it on for size, try to get a sense as quickly as possible for whether or not this is a hat that you want to wear. And maybe you have like 2 years of really fantastic tenants and fantastic experience, and that works out well. And then in the 3rd or 4th year, you get a nightmare situation. Okay, well, that's understandable, but always keep your eye on that clock because it's really valuable.
Yeah, no doubt. And it becomes more valuable if you've been in that home for a while and there was a built up gain. If you bought the home for 500 and you're going to rent it and it's still worth 500, it's not that big of a deal. You just got to think of it as, hey, I bought this for a low price and now it's worth X. That could be a very valuable piece to give up. So Jake, I mean, we're getting close to that 30-minute mark, and we might be able to keep it under that, which it would be a surprise for us. So anything you want to add to the conversation we're having about potentially, staying in your home and remodeling, or moving out and keeping your primary residence as a rental property?
Yeah, I mean, I think I'm just going to come back to a point I think we've made, before. But, when it comes to your primary residence, it's really tempting, and it can work well, but it can also not work well to begin to think about your primary residence as this, incredible part of your investment portfolio, this, really powerful part of your financial situation that you can leverage in various ways to, build wealth over time. Yeah, that's true. But at the same time, when it comes to your primary residence, you need a place to live.
Yeah.
Right. In so many ways, your primary residence, it's kind of an item of consumption. And in the way that we view kind of a primary residence, that usually is at kind of the top of the list in terms of, kind of how that fits into your overall financial picture. If you've been building equity in the house, or if you're considering some of these other moves, yeah, we can explore all of these options and opportunities. But at the end of the day, the decisions that, we want to see folks making around their primary residence, we want those decisions to be the ones that fit for them and their lifestyle. And, if you want to move up in the housing market, do it because you want to, because maybe your life circumstances have changed and that fits for your situation. If you want to make these improvements on your house, do it because you want to enjoy them, right? Don't necessarily just do these improvements on your house because you want to increase the value of your property so you can sell it for more later. It's your primary residence. You spend the most amount of time there. Do it because you're going to enjoy it.
Yeah, it's where we spend most of our time. You do want to enjoy your home. So, Jake, great chatting with you about this. I appreciate the fun facts, which we got out early in the conversation, and we'll see you next week.